Okay, so now let's start the past paper practice question. The name of the question is Pink's Company, and it is the past paper from your March June session 2019. Let's see what the requirements are. So there are two requirements, and we are only going to discuss the relevant NPV requirement. So first requirement is to calculate the nominal net present value of Pink's company's investment project. So I told you nominals and money, they means the same thing, so you should not get confused. So you have to use money method, or you can say nominal method of calculating the NPV for the Pink's company's investment project, and then you have to calculate the NPV using the real method as well and comment on your findings. Obviously, you have to tell whether you should go for the project or not on the basis of the answer that you will get. So let's start. Let's look at the question and start solving that. Pink's Company is a large company listed on the major stock exchange. In recent years, the board of Pink's Company has been criticized for weak corporate governance, and two of the company's non-executive directors have just resigned. A recent story in the financial media has criticized the performance of the Pink's Company and claimed the company is failing to satisfy the objective of its key stakeholders. Now, this paragraph relates to the second part of the requirement part B, discuss four ways. So we are not going to talk about that. We will just talk about the NPV right now. So let's start from the second paragraph. Pink company is appraising an investment project which it hopes will boost its performance. Okay, so they are considering to invest in the project, and the project will cost 20 million, payable in full at the start of the first year of the operation. The project life is expected to be 4 years. So the project will be of 4 years, and uh, forecasted sales volume, selling price, variable cost, and fixed costs are given to you. So the initial investment is 20 million, which means 20,000. Then you are being provided with the details of the sales each year, what is the selling price each year, what is the variable cost each year, what is the fixed cost each year. Uh, then selling price and cost are in current price terms. So all of this data, the selling price or the cost that are given to you, they are in current price terms. So basically, they are real cash flows. Before applying selling price inflation of 5% per year, which means you haven't applied the inflation, and the inflation is 5% per year for selling price. Variable cost inflation is 3.5% per year, and fixed cost inflation is 6% per year. So now in this question, all of the specific rates are given to you. So you are going to use this specific rate to inflate the real cash flows. Okay. Then moving on, Pink's company pay a corporation tax of 26% with tax liability being settled in the year in which it arises. So it means that the tax payment is not in the areas, it is in the same year. Okay. The company claims tax allowable depreciation on the full initial investment of 20 million on 25% reducing balance basis. So WDA allowance or tax allowable depreciation is 25% reducing balance. Scrap value is zero of the project. There's no scrap value. Pink's company has a nominal after-tax cost of capital of 12% and a real after-tax cost of capital of 8%. The general rate of inflation is expected to be 3.7% per year. Now, in this question, the specific rates are given to you as well, and one general rate is also given to you as well. Now, you guys should remember in the class, I mentioned this point as well, that if in the question both the general rate and specific rate are given to you, so if you want to calculate the NPV using nominal method, you have to inflate the figures using their specific rate, okay, to calculate the nominal cash flow and then work out the NPV. And to calculate the real NPV, you have to deflate those nominal cash flows using the general rate. You can go through your notes as well. That point is mentioned in the inflation notes at the very end point, the very last point. I told you that we are going to practice a question like that. So that is the question, okay? The past paper question. That in the question, if you are being provided with the specific rates and there are real cash flows, you will inflate them to get the nominal cash flows and calculate the nominal NPV using that. Okay, done. But when you have to calculate the real NPV, so a shortcut way, an easy way is that you can just deflate. Deflate means that remove the impact of the inflation from those nominal cash flows by using the general rate, that is 3.7% per year. How are we going to do that? We will do that here as well. So anyways, let's start with our question. And part A is we have to calculate the NPV using nominal method or money method. So I'm going to draw the format here as well. 4 years. So the life of the project. So year zero, year one, year two, year three, and year four. Initial investment. Well, wait a second. I can write it here as well. And now I will write triple zeros as well because all of the workings that I am doing, I will be doing in the triple zero. So it's important that you do that as well. So first of all, there is an investment of the project. Investment of the project is 20 million, which means 20,000. So I'm going to write a negative 20,000 here, okay, because it's a cash outflow. Then I have to write sales revenue each year. So sales revenue for year one, it's mentioned here, sale units are 300,000 and the selling price per unit is 130. And there is an inflation of 5% per year. So because we are calculating nominal NPV using nominal method, so I have to inflate the cash flows as well. So what I'm going to do, I will do is equal to my sales unit were 300 thousand. Well, it's in triple zero, so I can just write 300 here. 300 times selling price per unit 125 multiply by the formula I told you 1 plus r power n, where r means the inflation rate, which is 5% for the sales. So 0.05. In this case, its power is 1. So you don't need to take the power. So this will give you the figure. Okay, this will give you the sales figure. Wait a second. Let me see again. The inflation rate before applying the selling price, inflation of 5% per year. Yes, selling sales revenue is this, but wait a second. Three. I have made a mistake here. I did not write this. Okay. I just tried selling prices 12, but it was 125. I forgot to mention 5. So that is your sales revenue. Now there are two ways to calculate the sales revenue figure for year 2. One is equal to, you can do this the similar formula, 300 multiplied by 125 multiplied by 1 plus 0.05 power 2. Or the other way to do is that just multiply this figure that you got sales revenue for year 1 by 1.05 because you are inflating by 5% each year. So so just multiply the previous year figure with the 1.05 to get the after inflation cash flow. That will be 4134. Wait a second. Or wait a second. Or if you follow the simple method, 300. Well, we in this case we have to follow the simple. In this case we have to follow simple method. Sorry, we have to follow simple method because sales unit every year are different. Sales unit every year are different. So for year 2, how many units are you selling? 410. So 410 times selling price for year 2 is 130, and now you have to charge the inflation. So it's gonna be 1 plus 0.05 power 2. Okay. Or you guys can simply do 1.05 power 2 as well. Okay, you can do in this way as well. It will be correct. Just draw the brackets to show the effect. Okay. Then comes year 3. The sales unit for year 3 are 525,000. So we are doing the working in triple zero. So y 25 selling price is 140 and you have to inflate the selling price. So now I will do in that way 1.05 power 3. 1.05 power 3. So 8508 5.44, then again is equal to 220 times 120 times 1.05 power 4. So these are the answers. Okay, these are the figures. Now, look here, I did 1 plus because just to explain to you that you can do workings quickly as well. 1 plus 0.05, the answer is 1.05. So in the next situation, or even here, you can just multiply it with 1.05 power 2. Here you can just multiply that with 1.05 power 1 or just 1.05. Okay, you will still get the answer. Now, because the sales units and selling price were different, that is why the first method that I was trying to use, it's not effective here. But anyways, you can just follow the method that I told you here. Multiply the sales unit of the relevant year with the selling price to get the sales and then inflate it. Okay, then inflate it. After sales comes the variable cost. So variable cost again, we will use the same uh, concept here of the inflation. You have to inflate the variable cost by 3.5% per year. And because it's a variable cost, I'm going to write negative here because I will show that as a cash outflow. So for the year one, the unit that you are selling 300, variable cost per unit is 71, and the inflation for the first year it's gonna be 1.035 because it's 3.5%, which means 1 plus 3.5% will be equal to 1.035. So power 1, which means the same thing. So this will give you the variable cost. Then for the second year is equal to negative sales unit are 410 and variable cost per unit is again 71, and now you multiply that with 1.035 power 2. 1.035 power 2. So this will be the variable cost for year 2. Similarly, we'll do the working for year 3 is equal to negative, just to show that it's a cash outflow. The sales unit are 525 multiplied by variable cost per unit is 71 times 1.035 power 3. And for the last year is equal to negative. The last year sales unit are 220 times variable cost per unit is 71. You have to inflate that 1.035 power 4. So this will give you the variable cost for last year. Then comes the fixed cost. Fixed cost. So again, you will inflate the fixed cost. For the first year, it's gonna be negative is equal to minus 3000, and inflation rate for the fixed cost is 6%, so 1.06. For the second year, it will be 3100 is the fixed cost for the second year. Multiply that with 1.06 power 2. For the third year is equal to minus 3200 times 1.06 power 3. For the fourth year is equal to minus 3000 times 1.06 power 4. Because the prices were in the current terms, so we have to inflate them. So that's done. Now sales minus variable cost minus fixed cost gives you the taxable cash flows. Let me drag it here. Okay. So this is gonna give you the taxable cash flows. So taxable cash flows equal to sum from here to here. Control C, Control V. Just copy paste the formula. Okay. So I did what basically I copy paste the formula here. I put this formula, then Control C, and then copy pasting same formula Control V in all the cells, so it will give me the answer. Now we have to charge the tax, and the tax rate was 26%. So tax at 26%, so is equal to negative because it's a tax. Tax is a cash outflow times 0.26, and again I can do the same, copy paste the formula. So this is gonna give me the tax figures for each year. Now here I have to calculate the written down allowance or tax relief. You can write anything that you want to. Tax allowable depreciation benefit, whatever you want to. So I'm gonna write tax relief. Just a second. Tax savings. And tax savings we have to calculate. So let's calculate those. Initial investment is 20,000 and it is a reducing balance method 25%. So I have to do a working. So I will do working here. Working number one, tax allowable depreciation. So years, there are 4 years, year one, year two, year three, year four, written down allowance, WDA, and then tax savings or tax benefit or tax relief. So written down allowance for the first year will be the cost of the asset is 20,000 in this case. So multiply that with 25%. That will be the your written down allowance. Wait a second, let me These are small things, but you should be aware of that we, because we are doing the workings in triple zero, you should write triple zero here as well. Triple zero. Now I told you a shortcut. You just multiply this because it's a 25% reducing balance method, so you can multiply with this by 75. Similarly, you can multiply this by 75. But for the last year, we cannot do that because for the last year, we calculate either the balancing allowance or the balancing charge. So for the purpose of calculation of that, we cannot do that. Okay. We will do the working of that as well, but let's calculate the tax saving. Tax rate is 26%, so multiply that with 26. So you will get the tax savings. Multiply this with 26 and multiply this with 26 as well. Now, for the last year, you have to calculate the balancing allowance or balancing charge. How do you calculate that? Investment net of already claimed WDA. So, your investment was 20,000 and already claimed WDA is from this to this, right? These three is what you have already claimed. That you will do that less any scrap value, but here there is no scrap value, so you don't need to deduct the scrap value, so just deduct the already claimed WDA. That is going to be 8437.5, and now you will, because it's a positive, it means there's a balancing allowance, and on the balancing allowance you get the tax relief, so multiply that with 26, so it's going to give you the answer. You just need to put the relevant figures here. Tax savings for year 1 are 1300. Tax savings for year 2 are gonna be 975. Tax savings for year 3 are gonna be 731. Oh, no, it's not 73125. It's too much. It's 0.26. 0.26. At 26% means 0.26. So 71.25. And the last year it's gonna be 193.75. So you put that as well. Now you will get the net cash flows. Net cash flows. Net cash flows is equal to sum from taxable cash flows to this, and again copy paste, control C and control V. So these are the figures that you have got. uh, Now you need to discount them. Discount at, what was the nominal cost of capital? 12%. It's given to you, nominal after tax cost of capital is 12%, so you're going to discount that at 12%. Okay. So the discount rate for 12%, you can just, go through the table and you can work that out. Very simple. Here I have already available, the data is available, so I'm just going to put that. So discount factor is 1, then it's 0.893, 0.797, 0.712, and 0.636. So you can calculate the present values. Present value is gonna be this multiply by this. And then afterwards you can just copy the formula. Control C, shift, arrow press the arrow, drag it, and press Control V. Now automatically you got all of the present values, and now you can calculate the NPV, which is gonna be sum of all this. So from here till here. So this is going to be your NPV, positive 33,347. So that is your NPV using the nominal method. Okay. Again, I just inflated the figures using their individual rates, specific rates. I got taxable cash flows. From that, I deducted the tax. From the tax, I worked out the written down allowance benefit or tax savings or tax relief, whatever you want to call it. You can. Then from that, I got the net cash flows, and I multiply them with the discount factor to get the present value, and then sum of all this will give you the NPV. So that is the NPV using the nominal method. Now let's move on to calculate the NPV using the real method. Okay, so NPV using the real method. So that was second part. So wait a second. It's requirement A, and then onwards from requirement A, it's a part 1. So requirement A, it was part one, and now for requirement A part two, let's do that. NPV using a real method. So again, the note that I have referred to you, that we discussed in the class as well, as per that note, now you don't have to do all of this working again, right? The sales revenue, right? The variable cost, right? The fixed cost. No, you don't need to do that again. Simply, whatever the taxable cash flows that you have got, these taxable cash flows, they include the impact of inflation, right? Because you have calculated them by deducting the variable cost, fixed cost from the sales revenue, all of which figures are inflated, right? So basically, to deflate this means to remove the impact of inflation, because in the real method of NPV we have to use the real cash flows, right? So to deflate them, you can just simply deflate them using the general rate of inflation that is given to you, 3.7% per year. So here you are just gonna deflate them. And how will you deflate them? I will tell you, but let's draw the pro forma first. So again, I will just copy paste this, Control C and Control V. And here I need these figures again, but I can just I okay, I will do that. I will copy paste that, but let me first explain to you. So here you want a real cash flows, real real taxable cash flows. Okay, I will write real taxable cash flows because you have to charge a tax. So real taxable cash flows. Now, how will you calculate that? Please, look at this very carefully, because I explained this to you in the class as well, and I told you that we are going to do the past paper question as well. But before that, I have to write the investment as well. So let me write investment. Investment was negative 20,000. So now let's do the working. Now, look, first of all, real method means real cash flows. Real cash flows means those cash flows which do not include the impact of inflation. Now, instead of, doing these workings individually, you can just take these taxable cash flows and deflate them. And I told you in the class as well, in the notes as well, it is clearly mentioned that if in the question the specific rates are given to you and general rates are given to you, and examiner asks you to calculate nominal and real method NPV. So for real method NPV, you can just deflate the cash flows that you worked out using the nominal method. So the taxable cash flows were 14,149, 24096. Now all of these include the impact of inflation. Here I will just exclude the impact of inflation. Now how will you do that? Again, the formula is very simple. Right now for the inflation, I told you the formula was whatever the cash flow is, multiply that with 1 plus inflation rate power 1, 2, 3, 4 for each year, right? Now, to convert the nominal taxable cash flows into real taxable cash flows, you will do whatever the nominal taxable cash flows are, that cash flow divided by 1 plus r power n. 1 plus r power n. You will divide that. Remember in the management accounting, I told you how to calculate the future value and the present value. Future value was present value multiplied by 1 plus r power n. It means you were increasing the present value to the future value. You were increasing the, uh, I can say you were inflating the figures, right? And when you want to calculate the present value, the formula was future value divided by 1 plus r power n, which means you are deflating that. You are getting the reduced value, right? The less value. Here, the similar concept will be applicable. So now, well, you will do what is equal to this figure that you got for year one, the taxable cash flow, divided by 1 plus r. R, I told you repeatedly here, by r, I means inflation. And now because I am deflating using the general rate, so I'm going to take 3.7%. So 1 plus 0.037. Okay. Now you can take power 1, but it means the same thing. Or I told you a direct way to calculate is that 1.037, because 1 plus 0.037 is 1.037. So you can, instead of like showing the sum sign, you can just write 1.037 power 1 power 2 power 3 power 4. Now power 1 gives you the same thing, so you can just divide it with 1.037. So it will give you the figure, the real figure for the real taxable cash flows. Now you're gonna do same for the other one as well. So for year two figures for 24096. So divided by 1.037 power 2, bracket close. Similarly, here year three tax. Oh, sorry. I took the sales revenue. Year three taxable cash flow divided by bracket 1.037 power 3, and for the last year is equal to taxable cash flows this divided by 1.037 power 4. So 8973.935 is what you have got. Then you have to charge the tax. So let's calculate the taxable cash flows. Tax at 26%. Let's charge the tax. So multiply these with 26% times 0.26. Oh, I have to show the negative sign as well because tax is a cash outflow. So I can just copy paste the formula, Control C, Control V. Okay, simple. Just use the copy paste tool. Now tax savings and tax savings are calculated in the similar way. So yes, you can just use these figures that you have used above. So you can basically just link them is equal to just link these figures tax savings, link these figures 975 is equal to 731.25 is equal to 2193.75. Okay. The benefit of linking is that, let's say, for example, if I had calculated the tax savings wrong and I realized it later on, so when I will correct the tax savings from here, automatically the tax savings will be corrected in this section as well, and they will be corrected in this section as well. That is the benefit of the linking. That's why I always ask the student to follow this approach. Okay. Then it will give you the net cash flows. Second. Net cash flows. So investment will be there. So can just sum it. So Control C, Control V. So now we'll discount because I'm using the real method. So the real cost of capital is given to me, that is 8%. So I will discount it at 8%. Even if, let's say, in this question it was not given to you, so the specific rate is given 3.7%. Using that and using the Fisher effect, you can calculate the real cost of capital as well. Discount factor is always 1 for year 0, and the discount factors at 8% are for year 1 it's 0.926, 0.857, 0.794, and 0.735. Now you can calculate the present values is equal to this times this. Control C, Control V, copy paste. Now you calculate the NPV, which is gonna be sum of all these, and that is 33721. That is your NPV. So NPV using real method is 33721, and NPV using nominal method is 33347. These figures are in triple zeros. Okay. And you can see that answer is almost close to each other, and in the class as well I told you that using the both methods, the answer is almost like same. Here the difference is because you know the tax payment were different. In this situation the tax payment was slightly different, and the tax savings remains the same. Tax saving remain the same. So the difference is basically due to just these change in the figures and due to the discount factor. Okay, because of that a slight difference that arise. But anyways, you don't need to get like confused in that. So that is it. using NPV using nominal method and NPV using real method.